Let's talk about SIPs, systematic investment plans. They've been sold as the best way for retail investors to ride out market ups and downs, and that's something we've seen a lot of in recent times. And of course, the idea is simple. Invest a fixed amount regularly, and then the rupee cost averaging kicks in, and that smoothens out the highs and the lows in the markets, and that helps you build wealth over time. It sounds great for the most part, but what happens when the markets enter a prolonged downturn? History tells us that SIPs have not always worked as expected. There have been long stretches. If you remember 1994 to 2002, and then again between 2006 and 2013, that's when SIP investors, at least in mid-cap stocks, saw little to no gains, and some of them even lost money. But despite the recent correction, investors continue pouring money into mid and small cap funds, often ignoring the valuation warnings that are going out. So are SIPs truly a safe bet in a bear market? Or is blind faith in them leading investors into a trap? Let's discuss whether or not SIPs are a safe bet or not in a bear market. And to do this, market expert Sunil Subramaniam is with us. And with him from Chicago, Anurag Singh, Managing Partner at Ansett Capital. Welcome to India Tonight on ETNOW, gentlemen. Always good to see you on the show. But Sunil, I'll start with you. Historically, if you see SIPs, they've been marketed as this all-weather investment strategy. But would you at least concede that there have been extended periods when investors have lost money as well, despite staying invested for a decade?
That's just your mathematics, because basically what you're doing, let's compare an SIP to a recurring deposit in a bank, right? In a bank, you get the same interest rate every month and you get compounding at that impact, right? Now, in a volatile market, right, the rupee cost averaging that you just mentioned means that you buy more units when it's down and you buy less units when it's up. Now, the working of SIP depends on the maturity date of the SIP. Normally, SIPs are done to achieve certain goals, like a child's education abroad, or a wedding, or you want to go on a silver jubilee wedding anniversary cruise. So you save for a period. Now, if that maturity date happens bang in the middle of a bear market, right, depending on when you started the SIP. So if you've done 5-year SIPs, there are equal chances that in the midst of a bear market, you would have lost your money relative to the amount that you put in. But the moment you stretch that to 10 years and 15 years and 20 years, even in bear markets, even if it started in the highest bull market, you still made decent returns. So I think that the answer, to be very simple, is that short-term SIPs less than 5 years stand the risk of you losing money if you're stuck with the maturity in the middle of a bear market.
Right.
But if you see through the bear market, that investment in the bear market would have been your best value installment ever. I think that's the simple way.
I want to come back to you and ask you, considering the ongoing market downturn, one never knows how long that is going to run, and whether retail investors should reconsider their SIP approach, at least in mid-cap and small-cap funds. I'll talk to you about that in a moment, but for a moment, let me just go across to Bengaluru, where the Global Investor Meet is taking place. And that's where we're hearing DK Shivkumar speak right now, the Deputy Chief Minister of the state. Listening.
Bangalore, the economic powerhouse driving India's future. We are Bangalore, the global hub of innovation, talent, and digital leadership. Seamlessly, the power supply. We are Karnataka. We are the first choice of global investors. Bangalore, most popular city for the startup jobs. Bangalore continue to be the India's green capital and clean air vibrant product. I don't want too much propaganda on Bangalore. You all know you are live here. But again, you know that Bangalore second airport, which has started, is all on the international map. Mr. M.B. Patil and my Chief Minister, all of us working for the second airport again. We are on the first greenfield. You should know that we developed the first greenfield airport on the PP route. And now we have about 40 to 50 million passengers per year. A leading destination in the world-class infrastructure also being seen here. The fastest growing residential stock market. Mr. Our TVS group is here. Some of our friends are there. Lot of friends are looking on the residential group or residential share also.
So that's what we got from the Deputy Chief Minister, and that is currently happening in Bengaluru, the Global Investor Meet 2025 for Karnataka. We'll see exactly how that pans out, and we'll keep getting you the highlights. But let's return to our conversation about SIPs in bear markets. And Sunil Subramaniam, you were making your point, but I wanted you to elaborate on mid-cap and small-cap funds. Do you think that strategy of staying invested when it comes to SIPs, should investors do that, at least for now, in these funds?
Already seen a correction of at least 10% from the September highs. So compared to your SIP installments in, let's say, from April to September last year, you're already getting better value for your installment today, right? Number one. Number two is what goes up must come down. The stock market runs on the law of mean reversion, right? Now, this could go down a little bit more too, but ultimately it will come back up because mid caps and small caps are the best suited for SIPs because they are inherently more volatile, because the companies there are more operating and financially leveraged. So their businesses, both the top lines and bottom lines, go through massive swings and the stock market valuations follow through.
Yes.
So they are best for SIPs. Now, the key point is like this. One point I want to note, which has not come through in the market today, it is that pre-COVID, right, we had about 10,000 crores of SIP. Today we have 25,000 crores. It's a massive jump. But one of the key things which happened there is that, and since I work for a mutual fund, I'm aware of this.
Yes.
Prior to the COVID period and maybe a year thereafter, people used to put in money in SIPs for 2 years, 3 years, and 5 years.
Yes.
Then a technological change happened by which the bank mandate had to be introduced. And once the bank mandate was introduced, the SIP forms put 2099 as the end date. So technically, investors have put into the SIPs with a very long term.
Correct.
The problem is investor behavior of pulling out money before the SIP. Actually, SIP, they run it to maturity. It will be even longer than 20 years.
Right.
So, and the longer you run, the better you smoothen out the volatility.
That's the line we've always heard, but does that always hold true? Anurag saying globally, similar systematic investing approaches do exist. How do investors in developed markets, particularly the US where you are, how do they handle such prolonged downturns? Do they stick to dollar cost averaging like SIPs, or do they make tactical shifts based on market conditions?
So, Vikram, good evening, and Sunil sir is very respected. I've learned a lot from him virtually. But Vikram, allow me to make 3 points. I don't know how much time you have.
It's limited, but if you can make them quickly.
Yeah. Well, let me make 2-3 limited points, and I won't have too much to say outside of that. Okay, but point number one, Vikram, I am very skeptical of experts and market gurus who say stay for 20 years, you are guaranteed to gain. And in the same breath, people say past performance is not a guarantee for future. I don't think anybody can guarantee anything here, right? First point to note is, even if you say, oh, 20-year time, it has always worked because it has worked in the last 20 years, that doesn't hold true, right? So please be skeptical of that. First point. Second, Vikram, SIP analysis in India is a hindsight phenomena. Because nobody did it, market had prolonged bear phases of 7, 8, 10 years. Markets were extensively cheap. If you virtually, in the hindsight, go back and allocate money at that level, obviously you will come out very rich today, right? Point is, weren't there investors who knew that time in the market that market can multiply money? Probably they were, but it was too hard to take at that time.
Right.
It is very easy, never regret for taking money off the table. It is very easy to justify 10 years of prolonged bear market and say, oh, you would have made money in the year 15.
Yes.
It's very tough. I don't think anybody has the capacity to do it.
Right.
Last point, Vikram.
Mm-hmm.
World over, you can justify anything by taking an example of US, right?
Yes.
Economy is working great for 60 years. Market is rocking. Just for the time being, leave US. Tell me any other market where this has worked. It hasn't worked anywhere except India. Even there, experts are being disingenuous because they count 2002 to 2008 phenomena.
Yes.
The moment you take that phase out, even in India SIP, the case is very weak. These are the limited points, but I think we need to be very cautious, around the phenomena that it works in the long term. I don't think it works
Yes.
It hasn't worked anywhere in the world.
Yes, I remember that in November last year, you had put out that SIPs were initially meant to avoid market timing, but now there is some sense of overcrowding and investors chase higher returns by shifting focus to small and mid-cap funds. And you had also said that most new SIP accounts opened in 2021 during market peak valuation. So despite the growth, you've said that nearly 25% of SIP accounts were closed or deactivated in 2023. So there is a certain trend that you've tracked yourself, Anurag.
Even in December, as late as December, 5.4 million new SIP accounts were opened. But hold this, 4.4 million SIP accounts were closed. What's happening here? Even the investors don't have conviction. They are churning the money from this fund to that fund, looking at the last 2 years, 3 years, last 1 year, right? This itself shows that even the investors don't have conviction. They are simply chasing past returns.
Right.
It will spiral down as quickly as it has spiraled up.
Yes.
I have no doubt in saying that. Which is good or bad, I don't know, no value judgment. But these are markets. Please take your own call.
Right. Indeed. And that's typically how it is. But when you look at the kind of trajectory that we've followed on mutual funds, the SIPs have gone up month on month, Sunil Subramaniam. And like Anurag has pointed out, even in November last year, that the majority of SIP investments are buying stocks at inflated valuations. Do you agree with that? Because this might hurt more in a bear market as opposed to a bull market.
Nee, what you're saying is absolutely true, right? So when you're coming from a bull to a bear market, all your installments you bought in the bull are going to be in the red in the bear market. So the solution to that is, if you have the choice, do not redeem in a bear market. Wait the bear market through. Ultimately, the markets will reverse and the cycle will come. Whether it comes in 1 year, 2 years, 3 years, 5, we don't know. But if you do not need the money, like Anurag said, churning for the sake of searching for the next best cap curve or asset class, that's the wrong thing. But if you're committed to a particular thing, whether it's small cap, mid cap, or large cap, if you're in a bear market, yes, your SIP maturity value will suffer. So wait it out. That's the only psychological way.
You're saying wait it out, but even after a sharp correction that you spoke about, Sunil Subramaniam, the mid and small cap funds, they are attracting retail money. Some believe this is a sign of market maturity. That's one camp. But the other camp also believes that it is a bubble that is waiting to burst. Tell us which camp you fall in.
See, I'll tell you one thing. The first thing is that clearly I support Anurag saying that people have seen the returns and hence come to the market. But you know, the market has even earlier had phases of super returns and we haven't seen this penetration. So the mutual fund industry's campaign of mutual fund sahi hai, the advertising using the big stars and Dhonis or Sachin Tendulkar to push it has made an awareness of equity. And India, mind you, out of 144 crore population, we have only 5 crore unique PANs in the mutual fund industry. So I'm saying we are also in a penetration story. Yes, this penetration will suffer, the market goes through a prolonged bear phase. But all I'm saying is it's up to the advisor community and the mutual fund community to guide investors through this phase and tell them not to panic and to wait it out through the bear market. So what I'm saying is, yes, in a bear market, you redeem, you're going to be in trouble. So wait the bear market out. That is the only solution to this point.
So the media strategy is about awareness, but it doesn't stop at just awareness. People are putting their hard-earned money over there. So if I were to ask you, on a scale of 1 to 10, 10 being very concerned, how concerned do you say investors should be about the current valuations in the mid and small cap segments?
See, the valuations have been concerning for the last year and a half.
Exactly.
It's not new. But what's happened is that after a 10% correction, you have senior fund managers come and say redeem from mutual fund. See, that's absolutely a very sore point. See, the investors are already suffered for 6 months seeing their money go down. Now somebody comes and says redeem it. So I'm saying that the messaging at this point should be, look, we have been saying valuations are rich, switch, but don't stop your existing SIPs. Your fresh registration of SIPs, don't go and do it in the same small cap and mid cap. That's what I'm saying. We have the message right.
No, Anurag Singh, now you tell me about the Indian mutual fund industry, which has often been accused of launching these thematic and sector-based schemes at peak market valuations, and they're often the ones that yield the poor long-term returns as well. Have you seen such trends in the US markets, or are there lessons that Indian investors can pick up on that count?
No, so Vikram, those phenomena are not unique to India.
Right.
They say it is very easy to raise money. Even hedge funds face this problem. It is very easy to raise money during the bull markets, but bear markets, the money is difficult to raise. Even hedge funds, in fact, we have a, practice that we raise money during bull phases, but because hedge funds can go all cash and nobody can question, we raise money in bull phases, but we deploy in bear phases, right? So that's pretty well known. Mutual funds by design cannot do that because the mandate is if the money comes in, you have to invest. That's not the mandate so much in US, but that's a mandate from SEBI in India, right? So that's a bit of a problem. Second, Vikram, let me just also point out this 5 crore unique investors, but 14 crore DMATs.
Yes.
5 crore unique investors pretty much cover 20 crore at a family household level, that population.
Yes.
That is the only market in India. In India, 1 billion people live at $1,000 per year kind of income. They are not going to do SIPs ever.
Yes.
Whoever had to be in the market today is already in the market in India, right?
Right.
You can't find a guy who now wants to enter. There's nobody like that, right? It's kind of the peak. Now it's only...
Is it the peak? Is it the peak? Sunil Subramaniam, do you agree? We've spoken about this also in recent editions of India Tonight. Indian mutual funds, they've absorbed much of the FII outflows. This has happened in recent months. Which one could call it market resilience? What are the chances now that Indian investors are actually unknowingly overpaying for expensive stocks and risking future returns as a consequence? Because like Anurag is saying, that market now is not expanding. You're not going to get too many more people investing.
No, you see, that's why SEBI has launched this paper on making it down to 250 rupee SIP, trying to get it down to those $1,000 income people. It's a long process. See, I would say yes, penetration-wise, but I would not equate this 5 crore unique to 20 crore, into 4 multiplier.
Yes.
Because a lot of these demat account holders are not the SIP guys. They are the young software professionals who want to, it's the greed at play, right? I don't think they are all mutual funds. So there is a distinct set. And I do believe this 5 crore can go to 10 crore easily. Maybe it won't go to 30 crore or 40 crore. But I think there's still a penetration thing about it, 5 crore going to 10 crore. That's possible. Second is, mutual fund managers have been playing safe. If you see the fall in the market versus fall in mutual funds, right? And I did a study and I just had access to a study and just shared it with you. So to January 2008, if you're invested in the Nifty Small and Mid Cap 400, and you had redeemed it in, let's say, May 2014, when around the time Mr. Modi came to power. That was one of the most volatile periods of Indian stock market, right?
Yes.
A lump sum investment made then made only 0.5% return by May end, okay? But a SIP done through that period delivered 15% annualized returns. So why I'm saying this, if you are seeing a period of prolonged volatility in the market,
yes,
your SIP installments will deliver. So to me, the messaging is very clear, right?
Right.
This set of new investors who come into the industry, we have to protect them.
Sure.
We have to tell them,
yes,
do not redeem or churn in a bear market. Hang in there. That's the simple way that I would address.
Well, from what both of you are saying and highlighting, there's really no taking away from the power of SIPs as a long-term investment strategy. But somewhere we need to realize, like any investment, nothing is entirely foolproof. There are phases in the market, valuations vary, investors' risk appetite can change. All these factors play a crucial role in determining how effective our SIPs are. And while sticking to SIPs through market downturns has historically paid off, blind investing without understanding valuations or economic conditions can actually erode capital as well. And investors need to assess their risk tolerance, their goals, their cycles of markets. A big thank you, Sunil Subramaniam, Anurag Singh. Always a pleasure getting your invaluable insights here on India Tonight. We take a quick break. On the other side, we talk about the rupee against the dollar because the